The Reserve Bank of India has tightened the stress loan norms, and CB Anthony he represents Edelweiss ERC. CB, good morning. Thank you for joining us. Now, CB, I just want you to clear the air. Do you think the new RBI norms will they be applicable to the fresh loans, or this also would be applicable to the existing loans?
I think the guidelines are very clear. It's applicable to all the loans where the restructuring has not been implemented as of date, as on the date of circular. So if it's not implemented as on the date of circular, all will have to follow the new guidelines.
Okay. Now, CB, is this, this is a great and a bold move by Reserve Bank of India to clean up the entire banking sector. But this entire move will come at a cost. And I'm not so sure if the small and mid-tier PSU banks can really afford to bear the weight of provisioning in this kind of an environment where they are not getting a lot of money from the government. The credit cycle is broken down and the treasury yields are moving against them.
See, first of all, it's a great move by Reserve Bank of India. This was, in fact, in my view, it was long overdue because so many schemes with so much eligibility criteria, conditions of restructuring, this all was they were creating a lot of confusion. I think now it's a very simple, generic framework that's come. That's a great move. Now, to my mind, on your question, I mean, ever since 2015, after AQR, Asset Quality Review by Reserve Bank, I think most of the assets have been identified and provisioning has been started. Barring maybe a few power assets where, because of some regulatory forbearance, provisioning was inadequate. I think now with this guideline, all those will have to be identified and provided for. Of course, there may be some SMA cases, but SMA cases also you have 180 days to resolve now. So I think there will not be that much surge. Maybe my calculation may be around 60 to 80,000 crore may have to be provided for, which was factored in when the recapitalization also was announced, So I don't think there's a great negative for the banks. In fact, it's a great positive for the banks because restructuring would become much simpler.
Right. So we just stay with us. We've also got on board Karthik Srinivasan from ICRA as well joining in. And Karthik, morning. With the recent RBI norms, it seems most, we could see a rise in NPAs and most cases would have to be referred to IBC. What would be the impact of this according to you, as there have been very few cases being resolved under IBC in 180 days?
Yeah, as you said, the reported NPAs is likely to go up as part of this measure taken by RBI. But at the same time, maybe the overall stressed asset scenario may not go up because to a large extent that has got factored in. But optically on the reported NPAs, we could see a sharp spike. For example, if you look at the RBI report of financial stability, SMA2 accounts for about, at a system level, close to 3.5% of the assets, and a sizable part of that may need to get reclassified as part of the new guidelines. So to that extent, there could be a smart jump in terms of NPAs, and accordingly, the provisioning cost could also go up. As we've seen over the last 6-7 months, the cases where the RBI had asked banks to initiate action under NCLT or get into some sort of a resolutions, things are yet to see conclusion. And now with this new trigger of all assets above 2,000 crores and in default as of March 1st needs to get resolved within a period of 6 months. So timing could be tight. So we could see, based on past trends, more number of assets could potentially move to the NCLT, which means, again, the provisioning requirements could go up. So one has to be a bit watchful over the next couple of quarters and see how things really pan out in terms of how fast and how well are the resolutions done for a lot of these delinquent accounts.
Means that you're going to be very busy because the government, the RBI rather, has stepped up on rating these loans as well, Karthik, especially above 2,000 crores. I think they have to be two credit rating evaluators giving their clearance on the credit profile of these loans. But Sibi, I just want to wrap up this discussion. This is going to be, of course, the talking point all day long, but just wrap up this discussion with your sense of, what this does for the bad loan pile of $150 billion that we are contesting with right now. Is it in a meaningful manner likely to reduce the pressure in due course, while there might be some interim pain and adjustment to the new process, so to speak?
I think it would be an adjustment to the new process. If you look at while there obviously would be short-term pains, but with more frequent reporting that banks have to do to the acrylic database, effectively one can say that the whole measure, though painful, should improve the financial discipline amongst the borrower community, and also from a lender's point of view to be a bit more proactive in monitoring these accounts. You need to sort of report to RBI on a weekly basis on delinquent accounts above a certain level. And historically, we've seen a different attitude by borrowers when they service bank loans and when they service debt capital market instruments. So in a sense, we are seeing measures taken by all regulators to converge on the two. So while there would be near-term pain as people adjust, but over a medium term should really be good for the entire economy, and especially on the banking sector or the lending community as such.
Right. Sibi as well as Karthik, thanks very much for joining us this morning. This is going to be our top story, the NPA overhaul, and we'll get you the perspective from bankers, from credit rating agencies, from asset reconstruction companies, covering all angles to understand how this is really a step in the long term to clean up the banking sector.